Right now, as you're watching this video, gold is trading above $4,300 an ounce. Let that sink in for a second. Just 5 years ago, that same ounce of gold was worth less than half of that. Wall Street's biggest banks are now making a claim that sounds almost too wild to believe. Some of them think gold could be worth $6,000 or more before this year is even over. But here's the part almost nobody is talking about. Gold has already touched a price higher than that once this year, and then it fell hard. So what actually happened? Is this rally for real, or are we watching a bubble that's about to repeat history? By the end of this video, you'll understand exactly why gold is moving the way it is, what the smartest money in the world is betting on, and whether you should be paying attention to any of it. If you've turned on the news, checked your retirement account, or even just walked past a jewelry store lately, you've probably noticed something strange happening. Gold isn't just going up. It's going up in a way that reminds longtime investors of the most dramatic financial moments in modern history. And this isn't some fringe story on the internet. This is JP Morgan, Deutsche Bank, UBS, Goldman Sachs, and some of the most powerful financial institutions on the planet, all publishing official price targets that would have sounded absurd just a few years ago. In this video, we're going to break down exactly why gold has become the center of attention for investors, central banks, and everyday people trying to protect their savings. We'll walk through the forces driving this rally, we'll look at what happened the last time gold moved this fast, and we'll dig into what the experts are actually predicting, and just as importantly, why they might be wrong. This isn't financial advice. This is the story of what's happening with the world's oldest form of money and why it matters for your wallet right now in 2026. Let's start with where we actually are. As of early August 2026, gold has been trading above $4,300 per ounce, a level it hadn't touched since mid-June. To put that in perspective, gold spent most of the 2010s trading in a range between $1,200 and $1,400. For over a decade, gold felt almost boring. It sat there quietly while stocks and tech companies stole all the headlines. Then something shifted. In 2025 alone, gold set 53 new all-time highs. 53. That's not a typo. That's more record-breaking days in a single year than most investors see in an entire decade of watching this market. The annual average price of gold jumped 44% compared to the year before, closing out 2025 at just over $3,400 an ounce. And here's where the story gets even more interesting, because gold didn't stop there. In late January of this year, gold actually spiked to its highest price ever recorded, just under $5,600 an ounce. Read that again. Gold has already been higher than $4,300 this year. It touched nearly $5,600 and then it pulled back. Hard. It dropped all the way down into the $3,000 range before clawing its way back up to where we are today. So right away, this tells us something critical. This isn't a smooth, steady climb. This is a volatile, emotional market swinging on fear, policy decisions, and global events. And if you don't understand why it swings, you're flying blind. So let's talk about what's actually fueling this fire. To understand why gold is exploding, you have to understand what gold actually is. It's not just jewelry. It's not just a shiny rock. For thousands of years, gold has served one specific job in human civilization. It's the asset people run to when they stop trusting everything else. When people lose confidence in paper currency, when they worry that governments are printing too much money, when interest rates and inflation start behaving unpredictably, gold becomes the safety net. It doesn't pay you interest. It doesn't grow a business. It just sits there, and historically it holds its value when everything else feels shaky. So what's making people nervous right now? Well, a few things are colliding at the same time. First, inflation has remained a persistent worry for American households over the past several years, and even when official numbers cool off, the psychological scar of watching prices jump on everything from groceries to rent hasn't fully healed. Second, the Federal Reserve's interest rate decisions have become a moving target, with markets constantly guessing whether the Fed will cut, hold, or raise rates. Lower interest rates tend to be good for gold because gold doesn't pay interest itself. So when bonds and savings accounts offer less, gold becomes more attractive by comparison. Third, and this is a big one that doesn't get enough attention, central banks around the world have been buying gold at a pace we haven't seen in generations. According to the World Gold Council, global central bank gold holdings surpassed 5,000 tons for the first time in recorded history in 2025. Governments themselves, the same institutions that print and control currency, are stockpiling gold. When the people running the financial system start hedging with gold, that tells you something about how they view the road ahead. And finally, there's global instability. Geopolitical tension, from trade disputes to conflicts affecting energy supply routes, has kept investors on edge. In fact, just this past week, gold prices moved on news related to negotiations over the Strait of Hormuz, one of the most important oil shipping routes on the planet. When energy markets get nervous, gold often gets a boost too, because uncertainty is gold's best friend. Put all of that together, inflation anxiety, unpredictable interest rates, unprecedented central bank buying, and global tension, and you start to see why gold has become the story of the decade for investors. But knowing why gold is rising is only half the picture. The real question everyone wants answered is how high this can actually go, and that's where things get controversial. This is the part of the story that's been making headlines. Several of the largest financial institutions in the world have put out official price targets for gold by the end of 2026, and they are aggressive. JP Morgan has predicted gold could reach $6,300 by the end of the year. Deutsche Bank has said gold will top $6,000. UBS has projected $6,200. Societe Generale is also calling for $6,000. On the more conservative end, Morgan Stanley predicted $5,700, Goldman Sachs came in at $5,400, and Citi projected $5,000. Now, here's what's important to understand. These are not guarantees. These are forecasts built by analysts using economic models, historical patterns, and assumptions about future Fed policy, inflation, and global demand. Forecasts can be wrong. In fact, if you go back and look at gold price predictions from just a few years ago, almost none of them anticipated the level gold is trading at today. The market has consistently surprised even the professionals. But what makes these predictions worth paying attention to isn't that they're guaranteed to come true. It's that they represent a shift in how serious financial institutions view gold. These aren't fringe newsletter predictions. These are research desks at some of the most influential banks on Wall Street, and the fact that multiple independent banks are converging on similar $6,000 territory tells you the bullish case for gold has real institutional weight behind it right now. JP Morgan's own research team explained their reasoning in fairly clear terms. They pointed to what they called a structural diversification trend, meaning investors and institutions around the world are deliberately moving money away from paper assets like stocks and bonds and into real, tangible assets like gold. If that trend continues, the bank argues, gold has room to keep climbing. But before you get too excited about the idea of gold doubling from here, we need to talk about the other side of this story. Because the same volatility that took gold from under $3,000 to nearly $5,600 in a matter of months is the exact same volatility that could send it crashing back down just as fast. Here's the uncomfortable truth in all of this excitement. Gold already hit levels close to some of these bullish targets earlier this year, and then it dropped significantly. That January spike to nearly $5,600 wasn't the start of a smooth march to $6,000. It was followed by a sharp pullback that wiped out a huge chunk of those gains before the market found its footing again. This matters because it shows gold's climb isn't a straight line, and anyone telling you it hasn't been paying attention to the actual chart. Gold is being pushed and pulled by dozens of factors at once: energy prices, Fed policy meetings, jobs reports, currency markets, and global politics. And any one of those factors can shift sentiment overnight. There's also a historical lesson worth remembering here. Gold has had major bull runs before. It surged through the 1970s during a period of runaway inflation, eventually peaking above $600 an ounce around 1980. Then it spent the better part of the next 2 decades grinding sideways or falling, at one point dropping below $300 an ounce in the late 90s. People who bought at the top of that 1970s rally, expecting gold to keep climbing forever, waited a very long time to get back to even. That doesn't mean history is guaranteed to repeat itself. But it's a reminder that even the most convincing bull markets eventually cool off, and the investors who do well over the long run are usually the ones who understand that risk exists on both sides of the trade. Gold can protect you during uncertainty, but it can also test your patience during pullbacks. And right now, we are watching both of those forces play out in real time. So does that mean the $6,000 predictions are wrong? Not necessarily. It just means they're predictions, not certainties. The same banks making these bold calls are also the first to admit that near-term volatility remains a real risk. Now, if gold has been performing this well, you might be wondering how it compares to putting your money elsewhere, like the stock market. And this is where the numbers get genuinely surprising. Over the past 5 years, gold has appreciated by roughly 147%. Over that same stretch, the S&P 500 has returned around 74%. Gold has more than doubled the performance of the stock market over the last 5 years. That's a statistic that would have sounded almost unbelievable a decade ago, when gold was widely viewed as the boring, low-return safety asset that serious investors mostly ignored in favor of stocks. But zoom out to a longer time horizon and the picture shifts a bit. Looking back over the past several decades since the U.S. left the gold standard in 1971, stocks have historically delivered stronger average annual returns than gold, with the market posting average returns of around 10.7% per year, compared to roughly 7.9% for gold. So gold's recent explosive run is, in some ways, an unusual and historically significant moment, not necessarily the new normal. This is exactly why financial professionals generally talk about gold as a way to diversify a portfolio, rather than a replacement for other investments entirely. It behaves differently than stocks. It often moves in the opposite direction during times of market stress, which is precisely why some investors hold it as insurance against uncertainty rather than as their primary growth engine. And silver, gold's often overlooked cousin, has actually been outperforming gold on a percentage basis in recent months, something longtime commodity analysts say they rarely see. When silver starts leading gold instead of following it, that's historically been a sign of an unusually strong and broad-based rally across precious metals, not just a gold-specific story. So where does that leave us? Gold is sitting above $4,300 an ounce, having already touched nearly $5,600 earlier this year before pulling back. Major banks are projecting it could reach anywhere from $5,000 to over $6,000 by the end of 2026, driven by continued central bank buying, uncertainty around Fed policy, persistent inflation concerns, and global instability. At the same time, gold has proven this year that it can move violently in both directions, and history shows that even powerful multi-year gold rallies eventually give way to long, quiet stretches where the metal simply doesn't do much at all. Nobody, not JP Morgan, not Goldman Sachs, not any analyst on Wall Street, can tell you with certainty what gold will do next. What they can tell you is the reasoning behind their forecasts, and it's up to each investor to decide how much weight that reasoning deserves. Here's the takeaway I want you to walk away with. Gold's rise to $4,300 isn't a random spike. It's the result of real, identifiable forces, inflation worries, central bank buying at record levels, uncertainty over interest rates, and a world that feels less stable than it did a decade ago. Whether gold reaches $6,000 or pulls back sharply again, the deeper story here isn't really about a number on a chart. It's about what that number represents. It's a signal of how much trust people have, or don't have, in the financial system around them. Gold has survived empires, currency collapses, wars, and recessions for thousands of years. Not because it's magic, but because when people get scared, they tend to run towards something they can hold in their hand. Understanding that isn't just useful for investors. It's useful for understanding the world we're living in right now. If this video helped you make sense of what's actually happening with gold, do me a favor and hit that like button. It genuinely helps this channel keep making videos like this one. If you're new here, consider subscribing, because we break down stories just like this one every single week, cutting through the noise so you actually understand what's happening with your money. And I'd love to know, down in the comments, do you think gold is heading to $6,000? Or do you think this rally is running out of steam? Let's talk about it down below.